Hello, everyone, and welcome to Financial Inclusion. It's a webinar featuring Fiserv. We have Jay Iler and Jeff Vander Linden from Fiserv, and then us from Accelitas. So our panelists from Accelitas are Jimmy Williams and James Cook. Thank you all for joining, and thank you to our panelists for all their hard work prepping for this webinar. As a quick reminder before I kick it off to Jimmy Williams, please make sure that if you have any questions, drop them in the chat and we'll make sure to get to them. And then there will be a Q&A session at the end of this webinar as well. And we'll be sure to get everyone's questions in at the end. All righty, with that being said, I'm going to go ahead and kick this off to Jimmy and we will get the webinar started.
All right, great. Thank you, Sabrina. And thank you to everybody for joining today. We know you have a lot going on and try to deliver as much value as we can. So today's topic is going to be an interesting one that has been certainly more and more important from lenders of all different sizes. And it's really driving a more inclusive lending strategy. So we have a good group here together today. We'll do a quick review of the agenda. And one more slide. So in a moment, we'll go through some formal introductions of the teams and the companies that are here presenting this to you today. And we'll talk about what financial inclusion means in 2023. It means different things to different people. The key factor is making sure that we have an offering of services to as many people as possible. And some of the key challenges that lenders face in coming up with a strategy along those lines. Then we'll go ahead and introduce some pathways that really describe some best practices that allow you to develop a good strategy around that. And as Sabrina said, at the end, we'll absolutely have some room for some questions. And just as a reminder, any point during the process you have a question, you can just enter it in the chat box down the bottom. That process works pretty good. So just officially introducing myself, my name is Jimmy Williams. I'm based here in Pennsylvania. And my role is I lead the sales and client team here at Accelitas, and I'm joined by James Cook.
Hi all, James Cook. I head up the product efforts here at Accelitas. Been with the company for about 3 years. Spent most of my career in product management with different payment and data companies. So happy to be here today with you all, and echoing Jimmy's comments, thanks for taking some time to join us today.
Great. And just a little bit about our company. If you're not already familiar with Accelitas, we're an advanced data analytics company at our core. We primarily serve the banking, lending, billing, and payments industry with a host of different services that really range from account validation to lead screening to predicting credit and underwriting processes. Today, we're incredibly grateful to have with us our friends from Fiserv who are helping us to bring this information to you. I'll let them introduce themselves in just a second. And then this is that point where if you have little kids at home that watch Sesame Street, you're probably going to feel like the letter of the day might be J. All four of us happen to have names that start with J. We've not planned it that way, but that's how it is. So I'll kick it off to Jeff to introduce himself and then hand it over to Jay. Jeff, you might be on mute. Not hearing Jeff. Jay, can you hear us?
I can hear you. So
we'll see if we can get Jeff back on. I know he's joining by phone. We're having some issues with his connection earlier, but we're excited to have Jeff be part of this. But Jay, go ahead and introduce yourself.
Absolutely, and very excited to be here. So thank you, Jimmy. I'm currently serving the role of directing our product suite of alternative credit data at Fiserv. Spent prior to the last 2 years in this role, I spent 14 years in and around check and ACH processing in a variety of roles leading to this point. So really glad to be here. Thank you.
Guys, this is Jeff Vander Linden. Sorry for the little technical difficulties. I'm working on this through my phone since my computer's having a lot of fun today. So I'm the GM and the VP for our digital product group here at Fiserv. I run our group that centers around digital deposit origination and digital lending. So sorry for the interruption and the tech difficulties here from my side.
No worries, Jeff. Technology is our friend.
It certainly is.
So just a little bit about Fiserv, if you're not familiar with us. We are a fintech serving a wide segment of financial institutions, businesses, retailers, merchants of variety of kinds, and consumers directly. So this is our brag sheet with a lot of the areas that Fiserv is number one in acquiring and issuing, processing, and mobile banking, account processing, online banking technologies that we provide on the back, the core for financial institutions. And I think the most interesting thing is we do reach nearly 100% of United States consumer households. And then I think, Jeff, we have a couple of items on the underserved populations.
Yep. And, from a Fiserv perspective, what we're going to touch on a couple things around the underserved population. We see it in a lot of areas inside Fiserv, and we see it on the deposit side, and we obviously see it on the lending side with the need to expand markets. The slide that's up in front now is kind of a 4 bullet points Deloitte's put out in front of us to kind of give us some guidance as to how to walk through some things from our side. When we talk about inclusion, we know that the public is starting to have opportunities in the digital space to interact with us in a different way. We see younger and younger clientele coming through. We see underbanked and underserved clientele trying to get through. So the traditional look at how we have done credit and even deposit at our stage in digital is starting to change. The market is starting to move a little bit faster. So from our standpoint, we look at this going, okay, we have some table stakes we have to attend to, and Deloitte's kindly called those out, that we have to be able to help our organizations and clients move faster and innovate to try to capture that market. And again, we think about what is inside of all that extra data that is available. On the Fiserv side, we run a lot of core processing, so we have access or can have access to account information. How often is that deposit account occurring? How many checks are written on the account? How many the income and the outflow of that account are all available? And those are just some of the bullet points that we should think about as we put together a strategy to go after that more underserved market that may not have established a credit file yet. And Deloitte's kind enough to call out what we call the credit invisible borrower. Those are people that may be just paying rent and have done that for a long time, and we can find access to that information. Or they've got a traditional bank account that's been in great standing for a long time, but they haven't established credit because they're in that window of maybe the 18 to 25 year time frame where it's harder to establish a credit file. So you want to move on to the next slide here, Sabrina, please.
That's it.
Gotcha. So on the regulator side, we know that the regulators have started to move and started to change some things in gathering more and more data around borrowing, the borrowers and lending. We're all familiar with how we have to go through our HMDA and fair credit and all the traditional pieces of what we do from a lending business. And inside what we see from our client base is that they're starting to say, how do I manage this data? What do I do with this data to make it usable, reliable, and something that I can report and work with my regulator on and to prove that I'm hitting these markets? So some of the things that we've kind of talked through in the larger client base that we have, the compliance teams are very critical to this, as well as the credit teams, that they're able to look at the data, use it in a way that makes financial sense to the bank itself or the credit union itself, and they're able to track and control it. I think from our standpoint, you're going to see a lot of opportunity in this slide deck and this presentation to help you move through that process and maybe get some information in your hands to allow your compliance teams and your risk teams to start thinking about what it takes to move into this space. Because I think at the end of the day, the regulators are going to come out and kind of require we do some things that we all are going to have to get used to. So I'm happy to move this on to Jimmy, I think. Then we can keep moving.
Great. Yeah, so we have our first polling question here, and what percentage of your lending goes to underserved populations? Give everybody just a second. Sabrina, whenever you're ready. Yeah, that's I don't know how many responses we got, but that's pretty indicative, I think, of kind of what we hear in the market. So it's still in the lower end of things. So thanks for your answers along those lines. All right, so now we'll zero in and we'll try to boil it down to really these three big challenges, three big issues to solve for as we try to tackle this space. And this is what we know, and this is what we hear consistently. One is that those traditional credit models really result in a lot of thin file and no file situations for an astonishingly large number of consumers. And Jeff sort of talked about this a second ago as well. It's just it gives a good snapshot of a certain population, completely misses the representative population for tens of millions of other people. The second is that using those traditional credit strategies, it can give a good long-term picture for that subset of consumers. But what it does really lack is timely information. And I know Jay has some interesting data to share along these lines. Some of the things we probably all thought, but to be able to kind of see it, it really is kind of a wow moment. And then last but not least is that as we think about those traditional strategies, again, the data isn't that different. The scores aren't that different between bureaus when it comes to individual consumers. So though you may be using different bureaus or different services along those lines, there's not a massive difference between what you're seeing between them all. And you're still not really expanding past that prime credit population where there's a substantial credit file. So you miss a substantial number of potential customers for lenders. So next, what the team's going to do, and we'll have both teams operate on this, is to really introduce you to some of the ideas of how you can address these issues. Jay first is going to talk about how the Fiserv data can provide not just broader coverage to pick up the population that's completely missed by and ends up in those thin file, no file scenarios, but also incorporate some of that real-time data so that it's a better representative set of data that shows a picture of how that consumer is performing over a much shorter period of time. So as the market changes, they can pick up on that. And then James is going to jump in and talk about how Accelitas has been able to use that Fiserv data to deliver on those strategies as well. So we'll start with Jay.
Thank you, Jim. So before we dive into the contents of this slide, let's talk a little bit just about this is one data source, but it's a great data source to talk about in terms of alternative credit data because it highlights a lot of the strengths that you want to look for as you're looking for these data sources. So the telecheck data represents the ACH and check processing that we conduct, that we authorize and settle and stand in the middle of these transactions for, again, a whole host of retailers, e-com, brick and mortar, gaming, and sports wagering, and bill pay and government pay. As consumers who are putting their DDA account on file for their bill pay. So it's pretty broad in breadth. Sorry, that's redundant. It's pretty broad in that we have over 1 million updates to the database daily. If there are 600 estimates about the 600 million DDA accounts in the United States, we've seen 450 million. The database is made up of that 450 million bank accounts, another 350 million driver's license, and nearly 200 million social security numbers. So you take all of that and you make that kind of payment activity available in real time. Let's talk about what population this then represents. This is, as most of you are probably familiar, subprime is 650 and below on the credit rating, and that represents about 28% of all credit consumers. So those are the thin files, the no files, unscorable, the invisibles. It's interesting that that same broad subprime category represents up to over 60% of the new DDA accounts that are opened. So these are people who aren't using credit today or don't have access to credit. It may be, as Jeff mentioned, that 18 to 25-year-old segment that's just getting into their own financial responsibility. Maybe people new to the U.S. who have built up their credit in other countries, but as they have landed on our shores, don't have any visibility. We don't have visibility to them in the U.S. financial system. So they could be new to credit. They may not have access to credit, or they may have had a slip in their past and have been in the process of rebuilding their credit. So that's who it represents. And this is, I think, let's go to the next slide. Want to focus again on the fact that this is real-time data. So because it's real-time and it's about their payment history with either the DDA account on file or physical checks or entering their routing and account number in an e-com transaction. These transactions are live. We have obviously years of decades of history, but we also have recency of information. And the ability of a consumer to demonstrate their capability and willingness to pay and show a positive payment history is going to be much faster than what you see in a normal the normal traditional credit bureaus. So we can go ahead and move on to the next slide, Sabrina. So just we pulled a couple of quotes that we've seen from some of the credit scorers websites themselves. They state that updates can take a month to 45 days, and that's what they put on their websites. I think that we've heard more commonly that it can be up to 3 months to get the data collected, and that's prior to then getting scores updated. Obviously, consumers are when you're dealing with credit as a consumer, the lag, the latency in performance of a given credit account it's going to take some time before you have anything to gauge that on. By contrast, checks are, we know within 2 to 5 days whether or not it's going to be a return item. So we see lots of activity. We know almost instantly whether or not it's good or bad. And so it just creates a situation where consumers can elevate themselves and their rating for good propensity to pay quicker. Now, and then the last thing I want to say is you want to have somebody that has great experience with this. It's easy for me to point at Accelitas. They've been dealing with this data and in a collaboration with us on this for over 10 years. Fiserv is looking to find other data sources from around the rest of Fiserv, but this is one that has already been in the market, and Accelitas is extremely familiar with it and has done a great job of building models, and just been very happy with the things that we've been able to do with them. So thank you.
Appreciate it, Jay. And before James jumps in, just that slide that's up there, still just astonishing to me that that kind of lag for reporting along those lines compared to the activity associated with ACH activity that you all at Fiserv and Telecheck have. So just a huge difference. So
Okay,
next we have our second polling question of the day, and that is, what percentage of your underwriting leverages alternative data of some sort? And same thing, we'll just give a couple seconds here for an answer. Oh, there we go. Okay, so still again, kind of on the lower side of things in general, James. Any surprise or comments there from you?
Yeah, not too surprising to see that, and depending upon the profile of the folks in our audience, I know there's some lenders out there who've been a little bit more aggressive, kind of leaning into the alternative data, but there's lots of lenders out there who are still yet to kind of get into that space and discover that. So very interesting.
Yeah.
So, as Jay had mentioned, we at Accelitas have had some pretty robust experience with the Telecheck data over the years. And so a couple of different things going on in this slide. This is not meant to be a data analytics course, but just to take a minute to walk through these slides here. These are some typical plots that our data scientists use in order to, measure the effectiveness of the models that they're creating. And so if you look at the plot over on the left, this is called a area under the curve, or AUC plot. And a line that goes straight from the bottom left corner to the top right corner would be a area under the curve measurement of 0.5 or 50%, which is really no different than a flip of the coin as to whether or not your model is predictive or not. And so what the data scientists are trying to do is to find separation in the data that they're looking at to drive this curve up to the top left corner. And you can see on the left-hand side, the experience that we've had with real customers over the years, working with them and working with their data and the Fiserv Telecheck data in order to improve the way that our models are able to help them predict and, find strong performers and poor performers in the data that they're looking at. And so, what's important to take away from this is, as Jay had mentioned, we've been working with this data for years. It's a combination of working with the data to do tests. We typically do a retro data test with our customers to see how well the model and the data will perform for their specific consumer base. And so we leverage that experience here in the retro testing in order to understand just how the data is going to operate for us. But then that doesn't always translate to how well it's going to perform in production. There's always some nuances and differences when you go from a data test, kind of a historical retro looking activity, to what's actually happening in production today. And so understanding those nuances in the data as to what you may see in a test versus what you're going to get in production, we're able to get models tuned appropriately. And so our customers can kind of have the best performance out of our models. And so what you're seeing on the right-hand side there is just a depiction of, we've been able to continually improve the performance of our models through all the experience that we've had testing and running the Telecheck data in production. So next slide, Sabrina. So a little bit of eye candy here with this slide. But the point here being is our modeling approach and our experience here is the ability to really separate that data with our machine trained classifiers, right? And I'll point out, and this kind of ties into some of the points that Jeff was bringing up earlier, is this is all explainable fair credit data for lending decisions, right? And so our customers feel very comfortable when they have to explain to the regulators, their decisioning and what the model is telling them and why they're making their decisions, et cetera. And so it's important to kind of take that away. There's a lot of different, you'll see a lot of different communication in the press about alternative data sources, and folks are trying to come up with a bunch of unique and different ways in order to look at alternative data to make lending decisions. But from the regulator's perspective, right, they're there to, make sure that we're protecting the consumer's best interest. And one of the easiest ways to do that is to make sure you're working with FCRA-based data. And that's, what we've been very comfortable with, and our customers have been very comfortable with as we leverage the telecheck data in that aspect. And then our models can also be customized specific to a particular lender in order to kind of help them optimize their lending performance. And so if we go to the next slide, Sabrina, we'll talk a little bit more about that. So, these scores, both our generic scores as well as our custom scores, can work anywhere in our customers' workflows, right? And address various use cases, right? And it's not just replacing existing scores, although many of our customers have replaced existing scores with our services, but they can also be very complementary to existing scores. We were talking before about how a lot of these consumers don't have much of a footprint in the traditional credit score files, et cetera. And so sometimes customers have found that the combination of, a traditional credit report and some of this alternative data scoring really gives them a nice combination in order to optimize what it is they're trying to do in the lending space. And we also have customers who like to combine multiple sources of data. And so that's another benefit that we can bring to customers when they have, they may have some internal data that they're looking at in their own models. And then they work with us with the modeling that we're able to do with the telecheck data, and we're able to kind of combine those two sets of information for them. And so sometimes 1 + 1, it can be greater than 2 for them in terms of their predictability, et cetera. On that. So, a lot of flexibility here as to how the customers can kind of optimize things within their use case. And once again, it's all FCRA data that we're working with here with telecheck. So it's very powerful for the customers. Next slide. Yeah, and so this is another benefit here that we've been able to realize with our customers, is the ability to kind of tune and retune models from the feedback data that they're able to provide to us. And this will represent kind of what's actually happening in the marketplace, right? So, kind of analogous to what Jay was saying about the more real-time nature of the payment data that telecheck is able to see, right? When customers are able to give us feedback on the performance of what they're seeing in the marketplace, we're able to retune models where necessary, which is going to give them a better representation of kind of what's going on in the marketplace, right? So they can leverage, their own performance and adapt these models to see any changes that are going on in the marketplace. And, we're certainly dealing with a lot of changes that are going on in our marketplace right now. So this kind of reduces the time for them to be able to, tune their model and optimize their performance to make sure they're tracking what's going on in the marketplace here. And, as Jay was talking about, the payment data allows, consumers to more quickly kind of improve their score, if you will. That kind of ties into this activity as well here. So from an inclusion perspective, you're going to be able to see folks who are improving their performance, if you will, in this alternative data, at a much faster pace when you're leveraging this data and doing some, feedback optimization of your models, et cetera. So that's our approach. As a summary there, I'll hand this back over to Jimmy.
Great. Thank you, James and team. So as we get closer to the end here, just a quick reminder to, if you haven't already, to go ahead and drop whatever questions or comments you have in the chat box below. But I think the key thing here is that, regardless of what type of lender you might be, whether you're a big bank, whether you're a credit union, a community bank, whether you're an installment lender, whether you're in the automotive OEM lending space, captive credit, there's absolutely one easy way to grow your business is to expand your looks, right? Give that opportunity to make sure that you are looking at every single customer that you possibly can. And that's really, I think, at its core what this conversation is about, is these strategies for inclusion. So we hope there was something here that was helpful for you, and certainly the team, all of us are available for this discussion. So I wanted to just take a moment again before we move to questions and just give another big thank you to our friends at Fiserv. Tremendous number of our team here at Accelitas, myself and James included, are Telecheck alumni, and we have a number of other folks here who are both First Data or Fiserv or Telecheck alumni as well. And we would not be able to do a lot of the things that we have done without the relationship we have with them. So thank you guys for your time today. So with that, I know we've got a couple of questions come in. Let's go ahead and start answering those. And if we don't get to yours, certainly we'll try to follow up. Sabrina?
Yep. So as Jimmy mentioned, please, if you have any other questions, drop them in the Q&A and we'll be sure to get to them. And then as you could see on the slide here that we have Jimmy's information, and you could always reach out to him, and we can always distribute the other panelists' information to you as well. So I guess I'll let this question go off to anyone on the team or on the panel. As we look at the economic shifts that are currently taking place, where do you think the future of financial inclusion is headed? And then maybe I'll add this as a follow-up, but how does that relate back to the work that you were doing together, Accelitas and Fiserv?
Wow, it's like $1 million question. Anybody want to take that first?
I'll give you the $1 million.
Thank you. So I'll start. Maybe somebody else can chime in. So hopefully it's not in poor taste to talk about the pandemic in this way, but I think one thing that we saw during the first couple months of the pandemic was that some of our lenders, and I'm speaking from an Accelitas point of view, some of the lenders that we work with were seeing dramatic shifts happen. And, whether that was because of, shutdowns, whether it was because of changes in employment, or, whatever it might be, there were things occurring quickly. And some of the traditional models that some of those lenders were using just were, kind of too far of a rear view mirror. So it kind of speaks to that data that Jay provided. It didn't give a good snapshot of right now. And again, I'll speak on behalf of a couple of our lenders that, like, for them, that was their believe moment, where for them, they were like, yeah, we are glad that we have invested this time in looking at this real-time alternative data, because these consumers, the ones that are in the traditional credit file, now all of a sudden I know that the information that's in there is probably dated. So this real-time payment information is better. And then this other population who wasn't in there in the first place because of the lack of coverage, for them, certainly they were fully reliant on that. So I think in the same way, as we see economic turbulence in general, we see that the first indicator in a lot of cases is going to be through this type of payment data, such as through the Fiserv team that they have available. And I'll pass the ball to somebody else to maybe add. I get the $1 million for myself. Wow, that's awesome. Sabrina, any others?
Pulling it up here. So this person has actually asked to expand a little bit on the importance of coverage as it pertains to financial inclusion. That's probably a Jimmy question.
So I kind of spoke about it a second ago, so I'll try not to be super redundant. But so as we think about financial inclusion and what it means, I think the biggest opportunity is that it's all about missing people, right? Like the reality is that if you don't have a strategy to really understand how each person, and you really have to think about this as people, right? The moment we stop thinking about this as people and customers, we lose, right? But you know, the opportunity to make sure that I have an opportunity to give an answer to anybody who is asking a question of, can I borrow money? Can I get a mortgage? Can I buy this car? Whatever that is. That's what inclusion is all about at its core. So knowing that, and I'll cite the numbers that are out there, and it's a pretty wide range, but you know, anywhere from 40 million upwards to 80 million people are, depending on whose numbers you like, are in that credit invisible or underserved marketplace, right? So that's a massive number of the US population. So simply saying I can't address that space isn't acceptable anymore. And that's I think what we're hearing from the markets, we're hearing from regulators, and I think that drumbeat's going to get louder and louder and louder. So having the right coverage by not being bore-sighted or perhaps tunnel vision on just maybe traditional models, having more of a champion challenger approach of how do I make sure that my experience for my customers gives me more opportunities for yeses. That's where we're at, I think, as a professional group.
Yeah, and just to leverage some of the points that Jay was bringing up earlier, I mean, 61% of the newly opened DDA accounts seem to kind of fall into this space, right? So it's important for inclusion purposes, but it's also just important for your business, right? If you're not addressing 61% or 60% of the people that are out there, then you can improve your business just upon that.
Yeah, I think somebody said, and I've been repeating it for a while, easiest way to grow your business is to take a look at your existing business and say, hey, who am I missing, right? So looking at your customer experience and looking at that top of your customer acquisition funnel, who's missing from that? What else we got, Sabrina?
That was actually it. I think all of your questions were answered in the content. If anyone has any follow-up questions or just wants to reach out to our team, be sure to send us an email or find us on LinkedIn. And then, Jay, I want to thank you and Jeff once more and your entire team at Fiserv for joining us on this webinar and all of your hard efforts here. So thank you all for joining us today. We're almost at time, and I want to be mindful of that. And once again, please reach out to us if you have any follow-up questions or comments.